Welcome to Stock Cheat Sheets, where we trend, rank, and grade stocks and exchange traded funds. Our data helps forecast which parts of the market are about to get hot and which equities are likely to blow up in your face. You can subscribe and get cheat sheets delivered to your inbox. Best of all, it's free. Go to stockcheatsheets.substack.com to learn more.
Now, here's today's free update.
Advantage Investing Podcast. I'm Mike O'Connor, the author of Cheat Sheets. We're a Substack blog, and we release data about market trends for intermediate trend following. And that's the point I want to make about this blog. It's very specific to one strategy, which is all about a weeks to several months trend following system where we're looking at the stock market, bond market, commodities, trying to make decisions about where the strength is in the market, and then chasing that strength down to the individual security level. And that's kind of how I've been trend trading for close to 30 years. And market conditions are an important part of trend following. I should mention that any kind of short-term trend following system like the one that Cheat Sheet specializes in is not tax efficient. So it's something that I do in my with a very small portion of my retirement as a way of kind of trying to outperform the market. But I also keep a little bit of cash in a brokerage account. It's not my big stuff, let me tell you, in terms of saving for retirement or for kids' college funds or having an emergency fund and all those basic financial checklist items. I don't put that at risk with this system. This is my fun money. And I realize it's hard to save fun money in this inflationary environment. Well, I've been doing this a long time, and I've been able to build up a fun money nest egg. And I use it to basically trade up to fund things that are beyond my ability to afford. Now, I'm a typical middle-class schmo. I participate in an agency that specializes in digital marketing. And while I've had a successful career, by no means does that salary help me do stuff like this. So trading and investing has given me the opportunity to upgrade my travel, mostly vacations, to business class air or luxury resorts or higher end cruising that I would never spend my real money on. Okay. And that's where my investment discipline has come. I actually eat my own cooking. Cheat Sheets is a series of steps that I take to find the strength in the market and to gauge the safety of the market environment, and then make decisions about whether or not to put that fund money capital at risk. Because my goal is to fund nice vacations. Now, the first half of the year was great. The first quarter of the year. And that was it. I was able to put my Silver Seas January of 2025 cruise on the docket because of that. And it was just because the market was extremely bullish. I mean, you could throw darts. But of course, we didn't throw darts. What we did was we followed the strength in the market. And then so we knew that the U.S. tech sector was kind of driving this. And really, if you want to get right down to it, it was 7 stocks that were driving a lot of the appreciation in the market. And we showed you in Cheat Sheets how you go from market strength to sector strength, and then subsector or industry group strength. And then, for premium subscribers, we add single company stock picks. So you can go to cheatsheets.com or stockcheatsheets.com, I should say, or go to Substack and look us up. And you can subscribe. The ETFs analysis we do is free. So market conditions and ETF picks, always free. That's worth just giving up your email address for. And then if you're a premium subscriber for $5 a month, a couple times a week, we extend that process and add a fundamental screening to our work as well to find stocks likely to appreciate in price and that aren't likely to blow up in your face because of some kind of internal accounting scandal or overvaluation, which can happen. So my stock analysis skills, I guess, get added to the premium subscription. That just takes time. But whether you decide to come along for a free ride or a paid ride, I appreciate you having you. The other thing about the Unfair Advantage podcast is we're obviously not going to get to you the morning before the market opens. As we go through this exercise today, Market's up a little bit here on Monday, April 9th, pre-market. We're about a half hour before the opening bell, but likely by the time you watch this video, it will be one day, maybe even 2 trading days into the new week. So the purpose of this video podcast weekly is really just to help us understand market conditions and the bigger picture, because that's what we'll focus on, and also the how-to, what to look for in the data that I release during the week that can be helpful to your own trend following cause. All right. So I always start with the health of the market, and the large cap SPY ETF, which is the collection of the top 500 companies, but it's market cap weighted. So the bigger your valuation is, the more important you are in the index. And obviously the big 7 tech stocks have been driving the index until recently, until they stopped. And so one of our bellwether data points in Cheat Sheet's data stacks is the 10-day moving average relationship with the 40-day exponential moving average. So 10 EMA, 40 EMA in red, green, 10-day exponential moving average. Very simply, when the green line crosses below the red line, the intermediate weeks to months market trend is bearish. Now, you could say, well, what about the last 5 days? We've been drifting higher. And I'd say, yes, that's true. But until that moving average crosses back above the red, I just take away from this chart and from my own trading philosophy that we're bearish for the most part. Now, by bearish, I don't mean the stock market is crashing or going down. A lot of times bearish indicators will fire, and all that happens is we get an extended intermediate consolidation period where the market goes sideways. That's to be determined whether or not this is the beginning of a series of lower lows and lower highs, meaning a downtrend, or whether we're going to potentially trade right back up to this level of 522 on the market and gyrate from here. But what we are saying is that the trend, this is not the safest environment for that weeks to months trading strategy where you're basically chasing a moving average, right? I like to use the 40-day exponential moving average for any of my trades, and I put a little bit of a margin of safety below that 40-day moving average, and that becomes my exit point. So I use something called ATR. You can use any sort of vehicle that you want. I use the about 1.5 ATR below the 40-day moving average. And that simply means that I take an average true range of whatever the security is, meaning the difference between the highs and the lows. And I average that over a period of time and then put a little fence kind of underneath the 40-day exponential moving average. And that becomes my line in the sand. So we got out of a lot of positions here when we fell below my fence. Okay. So let's take a look at the big 4 major indexes as of the start of the trading week. And you can see that we are very bearish. Cheat Sheet uses a tailwind score. That is a composite of 10 factors, none of which are proprietary. By the way, the tailwind score is proprietary because the mix, meaning the weighting that I assign to each of these 10 factors, is important in determining what I like to call the tailwind percentage, just how much is the wind at your back. And unless we're over 50, we're bearish. And so a real simple way, if you don't want to get into the weeds about what these indicators means, is when it's red, no go. When it's green, when it's light green, yeah, maybe dip the toe in the water. And when it's fully green, get in. And what I mean by get in is don't get in too late, because when we get a tailwind score over 85, for example, it means that a lot of the easy money has been made and it gets harder from there. The market is starting to become overextended. Certainly not impossible. Markets can stay 85 to 100 for weeks, if not months. It just means that you've missed the bigger move, which is that kind of sweet spot in between the bottom and the absolute top. And when we're below 30 on the tailwind score, it means that not only are we bearish, but there's the potential for the downtrend to be exhausted. And then we start looking at the data more seriously about the potential for reversal. And that's kind of where we're at right now and this week, looking at the market. Okay, we've got a lot of very bearish numbers, all 4 major indexes under 30. And but you can see the one thing that hasn't happened is we haven't lost the long-term trend. Meaning when you look at the 10-week moving average, the green line, and the red 40-week moving average, that's not what you're seeing here. This is the daily chart. But if you were to see that as a, on a weekly chart, and as long as the green line is over the red line, we're still bullish. And that's long-term trend. Factor one is basically we have not lost the long-term trend in the market. So we can go sideways for months. We can drift down. And as long as those two moving averages don't cross, then we're dealing more likely with the consolidation. Now, of course, this is going to be a lagging indicator, as are all of these on the left-hand side. These are moving averages. The intermediate trend, well, as I told you, green is below the red. This is the weekly or the daily moving averages. And these are all 1040s. And this short-term moving average, and we've recovered the short-term. For this particular data stack, it's the 10-hour moving average above the 40-hour moving average. So that's, like a 1 day over a 2-day chart. So it's very short-term. Buying pressure is a very important metric. And I would argue that factor 4 and then 8, 9, and 10 are probably the most important for trend followers like us who may want to make a couple of bets about getting in early. But we never do that when buying pressure is underwater. And now the good news is the buying pressure has gone from bearish, with the exception of the SPY, to only neutral minus, meaning slightly bearish. And so there is a potential for buying pressure to turn around. Buying pressure is basically a scale for what's an indicator called Chaikin money flow. And essentially when we're neutral minus, it means that we're under zero for the buying pressure, meaning the Chaikin money flow, but we're not disastrously so. I think it's 0 to negative 0.5. So it's minorly bearish, all right? And that's better than it's been. So this is a really important indicator. I'd say your eyes go here first when you have bullish or particularly very bullish buying pressure. That means institutions are accumulating in that particular ETF category, okay? Relative strength, I'm gonna stop. I'm gonna skip that one for a second. And then I've done video after video. If you saw any of those videos with my nephew from a year ago, we spend an inordinate amount of time on these 4 indicators. So I'm not gonna do that today. There's plenty of educational material on cheatsheets.com, stockcheatsheets.com, for you to come and grab that. But what I will say is that we did not get that big pop that would have turned. Friday was a big up day. Google announced incredible earnings and the market gapped higher. And we had momentum through most of the day except the last hour of trading. And that's why we didn't get a big green pop in factor 10. This is the shortest term of 4 market forecast oscillators. Market forecast is a proprietary set of black boxes that TD Ameritrade provides its customers. And we use it simply as a measurement tool of the momentum in different time frames. So we call this the forecast because we're extrapolating velocity of price, right? So if you're in a car that's accelerating, I think intuitively you understand that it means that in the future you're likely to be going faster. Now, of course, there's always the chance that we could slam on the brakes, but that's the principle behind these oscillators. So this is the shortest term time frame, factor 10. Momentum, it's that hours to at most a couple of days time frame. The near-term forecast is next. That's the swing trading time frame, or roughly a couple of days to maybe a week or two. Okay, and when that gets bullish, things get interesting. But we like the momentum to push that into the green. And then intermediate. This is our time frame. So intermediate trend following. This says that for at least a few weeks to potentially a few months, roughly 2 weeks to 3 months. This is our time frame for market moves that last that long. And then the long-term forecast is 3 months to up to 2 years. Mostly it's about 9 months on average. Okay, so what we need to have is strength in the junior time frames, and we'd prefer strength in the senior time frames. Now, what we're getting it over here, the actual trend, but what we'd like to see is the momentum to and again, that's acceleration. Remember what I said? If you're accelerating, then if you can infer that short of slamming on the brakes, you are likely to be moving faster in the future. And of course, instead of faster, substitute the word higher. So having a long-term forecast that is bullish or very bullish, it means that despite any short-term fluctuations in price or weakness in price, the fact is the weakness in the shorter term timeframes was not enough to change the trajectory. We are not, when we're bullish or very bullish, it means we're accelerating on a months to up to a couple of years basis. That's not happening right now in the market. So that means that there's a drag. There's a long-term drag on any potential recovery. We have to keep that in mind. And sometimes that's okay, as long as we're getting junior timeframes that are demonstrating a lot of momentum, right? For a turnaround to start, it has to start somewhere. It'll always start in the junior timeframes, work its way up to our timeframe, and then eventually turn that long-term forecast green. We don't necessarily wait around for that forecast, but we use the tailwind score to make sure that there's enough factors in the market that are safe. That's why maybe high 40s occasionally or low 50s, but I really like to see tailwind scores solidly in the 50s, if not in the 60s, at least in the subsector or industry group that I'm looking at. Okay. So from a macro perspective, we do have a slightly bullish intermediate market forecast. There's enough acceleration to say that potentially the next few weeks will be a little bit more bullish than not. Remember, the long-term forecast is saying slightly bearish. So they're kind of in conflict. It means that any intermediate rally is likely to be suppressed. Now, just weakly suppressed because we're only talking about neutral minus. Okay. If we get more bearish, the headwinds get stronger. And it's also suggesting that in the days to weeks time frame, the near-term forecast is pretty good right now. It's bullish. But we're not at that FOMO level where institutions are buying hand over fist. So neutral plus is a meh rating. We need to do more work and we need to dig deeper and look for strength. And so that's kind of what the market is saying right now. It's very bearish. There is a possibility that we're turning. And by the way, when you subscribe to Cheat Sheets, I'd urge you, and I should have done this, I can expand the stacks like this. So it's easier if you're looking at this on a desktop or laptop computer than on your mobile phone. Okay. But if you're on your mobile phone, pay attention to the tailwind score. It's really all you need. Okay. And then we kind of get into what I just got into in summary form on a lot of cheat sheets. I rotate through some help. You can always dive into the help guides, but we always put a few kind of road signs on our journey here. Okay. As we did here with the tailwind score, tells you that we're either a bit bearish. In our case, we're bearish. We're actually very bearish, but that there's the possibility that the trend is exhausting itself to the downside. Now, we also once a week, and you'll find this in your inbox if you're a subscriber. This is all free, by the way. None of what I'm sharing with you is part of our premium service. And this is where we're trending tailwind scores to get an idea of whether the market is getting stronger or not. And clearly the market had been stronger than this. If this had been the week of February 15th, we would have seen basically a sea of green with maybe an occasional red splotch. That's not what we're seeing here. The market had already begun to transition by this point, March 29th. And as you can see, fast forward 5 weeks and the weekend ending April 26th, we're mostly red, a few splotches of yellow and green, only one green, that's oil. And I think oil's off a little bit this morning because there's some government gumming going on about potential ceasefire or peace treaty or something in Gaza, which would be nice. All right. But you can see other than energy, which also trends as oil trends, XLE, and some precious metal activity that's settled, silver, and gold is probably a little bit stronger, GLD. Those have both come back a little bit. But the trend is interesting. The trend is interesting, and you're going to need to do more work to find out whether you're going to buy the dip. And Cheat Sheets will, I've actually got a data table that will help us with that a little bit later on. This is a data table that I didn't publish over the weekend, which we'll get to as kind of our last thing. All right. And then I should mention that I didn't cover every sector, and I should have. I forgot to do the lower rated stuff. But this is all the high rated ETF sectors. So again, as I look at the short-term momentum, nothing at the sector level exploded to the upside. Defensive consumer staples sold off a little bit. We've got to We did get some momentum to the downside, not enough to change the trajectory of XLP, which is not that bullish. But defensive utilities, that one's looking pretty good. And this is where I'll spend a little time on relative strength. So relative strength is basically all of these are being compared to the IWV ETF. IWV is the Russell 3000. It's the total market index, the total US market index. And we're looking at a 6 and a 3-month comparison to the total market. So if you've been underperforming for a while, it can take a long time before your 3 to 6 month relative strength turns bullish. So consider this very much a lagging indicator, but it is helpful to overperform over the long term. So we do add points for relative strength. It's a comparison on a 3 and 6 month basis to the broader US market. And you can see XLI, XLF, XLC, and the Qs are our persistent outperformers. So those are more, so the bullish trend is more likely to be persistent when you have positive relative strength, but you also need the tailwind score. All right. And so utilities, a defensive sector, a little bit of strength right now. Industrials, relative strength. And notice the long-term forecast is extremely bullish. And the intermediate time frame is in bullish agreement. It's very slightly bullish agreement. But whenever we have these two and we have buying pressure, not quite there yet, but I would say argue 7 and 8 bullish with positive buying pressure. Really doesn't matter what the tailwind score is. That's enough for me to be really interested. So XLI is still interesting. And I think you'll find aerospace is where, and defense is what's turning that. But again, we'll go do the work. Utilities, defensive sector. And now financials, they've come down a little bit here. They're not as strong as they've been. Okay. And then we give you a bunch of key links. And then I'll move to this second day's worth of stuff. All right, so that was our look at basically the markets and the sectors. Let me do one more thing. I got this here somewhere. I think this is an important one to show you. Okay, so this is, and I've got it spelled incorrectly. I'll fix that. Global macro trade signals. So this is macroeconomic. So what we're adding to the major index ETFs here are commodities and a couple other things like, and there's more to this stack than what I'm sharing with you, but this adds commodities and it adds the short sector, the short market. I'm sorry, the bond market. SHY is the 1 to 3 year treasury, and then TLT. The market just opened, by the way, as I record this, and TLT is the 20-year treasury note. So we basically add bonds and commodities just to see where we're at. And you can see commodities are bullish, just barely. And they're being propelled by intermediate and short-term strength. And the accelerator is on. So we're bullish even in the long-term time frame. This is pretty bullish. Where we're getting hurt is relative strength. But remember, commodities had been a serial underperformer versus stocks up until recently, up until the last couple of months. And remember, this is a 3 and 6 month look back period. So when you have an emerging asset class or an emerging index ETF or industry group that's been underperforming for a long time, these usually are the factors 5 and 6 are the last to turn. And that's why I would argue when you see very bullish buying pressure, you see bullish or better in the long term and the intermediate term, and you don't see any red splotches here in the shortest term time frame, that qualifies. So that's why we say that when we're between 50 and 60 and just slightly bullish, look under the hood and see what's driving the drag on that tailwind score. And when it's relative strength and you've made the assessment that it's because it had been underperforming for a long time and is maybe just now starting to turn around, then you can dismiss these very bearish numbers. And I would think about that with commodities. Now, of course, right now, the price of oil and agriculture are driving the commodity stack. And we'll do a deep dive on relative strength Wednesday to look more specifically at which commodities, but DBC is a basket of futures contracts that covers everything from precious metals to oil and natural gas and home heating oil and agricultural commodities like soybean, corn, and wheat. All right. And we're showing an uptrend bounce signal. That simply means that we're in a intermediate uptrend and stocks have pulled back and bounced off of what we call a low. How do we know? Because it's trading above the high of the low day. For those of you who are experienced with invest tools or Thinkorswim, you know what a hold is. That's a close above the high of the low day. When you do that and you're bouncing in while in an uptrend, cheat sheets will signal a bounce. So an entry signal last Friday. Of course, you need to go do the work now because the price of oil is down this morning, or at least it was when I reviewed the pre-markets. Okay. But everything else is bearish except commodities. So it means that's kind of not the best of perfect world. It means stock prices are meh to awful and prices are rising. That is not a good bellwether for the economy. All right. So that's that. Let's get back here. Now we're going to look at industry groups. So what we did was we looked at what are the strongest sectors. Were there any? There was no index strength other than commodities, and no real strong sectors. But when we look at industry groups, remembering what I shared with you about commodities, remember precious metals, energy, resources, and agricultural commodities. Well, no surprise, the stuff tied closest to that is doing the best. GDX is gold miners. XME is broader miners and materials miners. And XOP is oil exploration and production, all with optimal tailwind scores above 60, all with great market forecast indicators. There's one exception here. Metals and mining is neutral minus. Another update will probably turn that, especially given the fact that we had some momentum going into the close here. And of course, all three major timeframes are bullish. So this is definitely a place to fish for counter trend opportunities. Next up is capital markets. This is like brokerages and other things that make money off the business of money. KCE, that one looks pretty good. It does not have great buying pressure. That is a red flag for me. It means institutions have, and buying pressure is a bit of a lagging indicator, right? The standard setting for Chaikin money flow, which is what we use, is set to 21 days. And so you're looking at a 21-day average of buying pressure, but buying pressure is, again, it's about where stocks, where assets in this particular class close. Was it near the high? Was it near the low? And what kind of volume? And over 21 days, what's been the average? And when we're very bearish, it means that institutions have been distributing capital market stocks. So while we are seeing the beginning of a turnaround, the junior timeframes, we don't have that institutional nibbling underneath us to support it. So I really do not like to trade anything with very bearish money flow unless I'm seeing some kind of a divergence, which we won't get into today. You need a chart for that. All right, and then tech. This is basically a tech industry, and that did hit a very bullish 95%. So something popped it. Just beware that Google is a big chunk of XITK. That's the one that gapped up on Friday. You just want to look under the hood at other stocks in XITK to make sure that you're not grabbing that one because Google had an update on Friday. All right, there'll be follow through today. According to this, we should see follow through. Whenever we have a very bullish junior time frame and a very bullish near-term time frame, it was enough to turn around the intermediate market forecast with very bullish money flow underneath it. That's pretty powerful. Okay, and compare that again, capital markets. We don't have that institutional buying frenzy underneath us, but we do for XITK. So it's on my radar as well. And then I'm watching banks just because there's been a lot of bearishness. Now this is bigger banks. And then down below here are regional banks. Let's see, where is it? KRE, regional banks. Okay, those are much more bearish. And I'm just watching for red flags here because, the credit trends in America are not great. Commercial real estate lending looks awful. People are maxing out their credit cards. And so I worry that banks are holding on to a bunch of crappy loans, and that can as things get more expensive and consumers run out of gas, I do worry about a credit contagion issue really upending the markets. We watch that closely. All right. So that's strength at the subsector level. And then from there, and I'm not going to spend any time on this because you can subscribe and go get this. We go over some entry signals here, and you can see XME had a bounce entry signal, as did capital markets. You decide whether or not you want to trade capital markets with the bearish money flow. XITK, that had a huge gap up, so that one needs to probably settle. And then buy the dip on major banks. Up to you whether or not to take these signals. Remember, this is just a starting point, and all these signals will be explained in tutorials. So what's on tap this week is kind of an important week. I'd say the biggest two indicators of economic health are going to be the ADP employment report that comes out Wednesday, and then followed by Friday, the basically the April jobs report. We have a few other things like ISM manufacturing, consumer confidence, Case-Shiller. A lot of pundits are expecting all of these kind of leading market indicators to roll over, meaning the economy should be getting weaker because the Fed has not been able to cut rates the way it wanted to. Why? Because DBC, the cost of stuff, keeps going up, right? So stock prices weak, cost of stuff rising, interest rates higher for longer, much longer it would appear. And so we should start to see problems in leading indicators like jobs, more layoffs, manufacturing softening, because remember, producers try to anticipate demand. When they see the consumer rolling over, they break ground on less stuff. Of course, there is a bunch of government funding money on infrastructure flowing around. So that can be affected, this manufacturing index report. Consumer confidence, give you an idea of how people are feeling about things right now. And then home prices. I live here in Austin, and if Austin is any indicator of what's to come, we got some problems in the housing market. We've seen about a 20% decline in just a matter of months in housing prices here, just way overbuilt. Everyone was moving to Austin until they stopped. And there's way too much housing capacity here, and it is correcting hard. There are some earnings reports coming up. Most importantly, though, 75% of S&P companies have reported earnings, and it's about 2/3 of all companies have reported so far, and 3/4 are beating their estimates. But forward guidance is going to get more important than the actual beat factor. So I would pay attention to big economic bellwethers and their forward guidance in terms of what they expect to happen in the back half of the year. And then we have some ETF picks that are, no surprise, going to follow the theme that we just talked about. There's a few that I cover here in cheat sheets that I think are outstanding opportunities. This First Trust natural gas ETF, which kind of seems counterintuitive because natural gas looks awful. Well, what's driving the prices of FCG is more the refining and processing side of things. So ConocoPhillips and Hess, which are also into refining as well. And they're part of the they're part of the midstream production process. And so just imagine if natural gas starts catching fire. So it'll be more than the oil services portion of FCG, which is mostly a natural gas trust. But if that gets hot, this company gets that much hotter. Actually, it's not a company, it's an ETF, right? And then finally, for paid subscribers, premium stock picks, no surprise, energy, metals, miners, and tech are where they come from. And yes, no surprise, Google is on the list. All right, that'll do it for me. I'm Mike O'Connor. Thanks for watching. Thanks for subscribing to Cheat Sheets at stockcheatsheets.substack.com while I figure out how to turn off this friggin' audio stream. And there we go. I'll take that away, and I'll see you in cyberspace.